Welcome, everybody. My name is Anders, and that is Caroline, my wife. And we have been running this meetup for over a year and a half. It started off in pubs and then went to Zoom in March, April last year, which has been an even greater success because it's much more inclusive in many ways. People don't need to travel to a pub. Some people don't like pubs. Pubs are very expensive. And so it's really been a pleasure to see how it's developed. And every night it's we run it monthly, and every time there is a good core of regulars, and it's always great to have you back. And then there's a rolling crowd that come and go, and you're all very welcome. And what we try to offer you is a space to network with other people passionate about a range of topics. Sometimes we present, sometimes we bring in speakers. And really, although Caroline told you all to mute yourselves, that's only so we don't talk on top of each other. But of course, you know, the purpose of the evening is for us to engage, for you to ask questions. And we've got a lot of time for that. There's also chat, which we will keep an eye on, and usually becomes very lively. And you know, if you don't get the chance to talk, then type your questions and comments in the chat, and we'll try and bring them in at some point. It's a big crowd tonight. We are fast approaching 100 participants, which is great. And with that, I will hand it to Caroline.
Great. Anders, I can see you're having a bit of network problem on your side. Hopefully everything's switched off on mine, and just wave your hands around if I start to cut out. Great. We have a really special treat tonight, and I can tell because so many of you have signed up. We're very privileged and lucky to have Barney Whiter from the Escape Artist tonight. So you're going to see a very different format from us. We have no slides. We probably are not going to use breakout rooms because we want this to be a party with the 100 of us. And we really want to give all of you an opportunity to ask your questions. There's been a bunch of questions coming through on Facebook. Anders and I have our own questions. We'll try not to hog the evening too much and let everyone have a go. But yeah, we're just going to have a wonderful time speaking to someone who's really a hero of fire for me anyway in the UK, and is probably the reason that we have this meetup group today, although Barney probably doesn't know that. We first met about 2 years ago when Barney was hosting the Playing with Fire documentary. And Anders and I Barney managed to get tickets for Anders and I posted desperately on Facebook to say, it's sold out, please can someone help? And we went, and it was such a great event. And I was just, you know, filled with energy from the fire movement. And I said, why can't we go out and meet more people on a regular basis? And I looked, and there were no meetups and no regular groups who were meeting in London and talking about fire. So I said, well, then we just have to start our own. So that's really why we are here today. So it's my great pleasure to introduce and welcome Barney to the show. He's promised to at least let you answer any questions, at least ask any questions. He might not answer all of them. But without further ado, let me hand over to Barney. And I think you have the first question, unless Barney would like to introduce himself first.
No, thank you very much, Caroline.
Anders, over to you.
Great. Thanks, Caroline. And yeah, and thank you, Barney, for joining us. To get the ball rolling, perhaps people have read your story and studied your blog, but you really came into the fire movement inspired by your upbringing in the 80s with the high interest rates, which affected your family circumstances. So you were sort of self-inspired to live you reached a point of fire. We've had a couple of meetups recently looking at how to grow up with that and how to build a family with fire. You've been through all of that. Help us understand a little bit about your journey, your fire journey, and to the point where you are today, please.
Yeah, sure. So I, yeah, I mean, I kind of have to psychoanalyze myself a bit when I kind of figure out, like, well, why did I take this path? Why was I kind of unnaturally interested in money and investing and kind of getting myself in a situation where work became optional? And I think what I traced it back to, I think, is, yeah, in back in the day in 1981, my parents did the kind of classic thing of buying the biggest house that they possibly could, and shortly after that, interest rates went to 17%. And my dad worked in the construction industry, and it was kind of a really brutal time in construction. So there was a pretty good chance that he was going to lose his job. Plus, they had this kind of huge mortgage and two young children, and interest rates kind of went through the roof. And so, I've talked about this before. They had to tighten their belts pretty significantly, so the holiday got cancelled, and my dad couldn't afford to buy beer. He had to start brewing his own beer. We cancelled the newspaper, and all these things. And so I kind of took from that experience, I think, that there was something kind of a bit scary about being in debt, and that ultimately, my parents were fine. They kind of got away with it in the end. But I was aware for a few months it was a bit touch and go, and I was aware that ultimately the bank can take your house away from you. So that was one of my sort of formative experiences that kind of put me off debt early, and it put me off for life. And so I kind of, and it just sparked an interest. It was a very raw experience of how much power money can have over your life, for good or for ill. And so I did, I chose economics as a degree subject because I was kind of interested in money. It was a time when the city, people were making money in the city. So economics kind of seemed like an interesting area. And so, I basically was just determined to avoid the mistakes that my parents had made. And I was always very conscious that if you have children, it seemed to me like your first obligation was to kind of provide for the children, and provide that kind of a roof over their head, which some people, maybe some people take that for granted. I don't know, but I never have, because of that formative experience when I was 11 years old. And so now, I've got 3 kids of my own, and it's just, it was very clear to me. My children are a bit older now, so my youngest is like 15, and my oldest is 20 pushing 21. But when they were younger, it was kind of stressful to me, being aware that kind of feeding them, clothing them, housing them was kind of my sole responsibility for a number of years. And that kind of history was playing on my mind from my own upbringing. And really, it was at that point, when I was about 30, that I just decided, I'd always been a kind of sensible saver, but I decided to go hardcore. And I was having a kind of tough time at work, and I realized that I could lose my job, and it just kind of triggered me to go extreme, go into what I call monk mode. And so that was that was a long time ago now, but it just set me on the path of saving half of my salary every month, and anything that I got in terms of other income or bonuses, that all got squirreled away. And that was the kind of foundation of my sort of getting to financial independence about 11 years later. So when I was 43, which is 7 years ago now. So that's where we are now, where I am now.
Do you think it was the frugality that was the main driver between
Thank you.
reaching financial independence?
Well, I think you have to kind of pull every lever. It's certainly for me, I break it down. I say there's four pillars of financial independence. One is earn more. One is spend less. Number 3 is invest the difference wisely, and number 4 is know how much is enough. And I kind of think you have to do all of those things. I mean, if you just you can earn the biggest salary in the world, but if you're not investing and you're not saving and investing, then you're just not going to make it. You're just not going to make it. I mean, I worked in financial services, and I saw people earning huge salaries that never made it. So you have to do all those 4 things. I just don't think it's possible to kind of skip a step. And so I kind of did all of the above. I think everyone kind of needs to think about their own balance between, working hard, being a wage slave, kind of working long hours, those kind of sacrifices, versus frugality. And the way I put it is that it's like football. Some people are natural attackers, some people are natural defenders, but really for financial independence, you need to master both.
Great, thank you. Danny, you had a question in the chat. Would you like to ask?
Yeah, so you're from a working class background then. You've had no particular leg up, as it were, from the finance of the family as such. If your dad was a builder.
I've never inherited any money. My dad is from a working class background. So my grandfather was a sheet metal worker, and so my dad and they were kind of active in the labor movement. Actually, he was a trade union official, would you believe? Probably turning in his grave now. So my dad was from a working class background. My mum's from a middle class background. So I'm kind of a mixture of those two. But unfortunately, they've never given me any money.
So you're muddle class then.
Yes, exactly. I kind of that's actually not a bad way of putting it. I mean, I went to a comprehensive school, state school in the middle of nowhere, in the fens of Cambridgeshire, and so that was quite a working class school. I always say more people went to prison from that school than they did to university. So yeah, I kind of I think the whole sort of social mobility thing is a big and important part of this, because to me it's a tragedy where kids just they've just never seen it. They've no role model in their family or their sort of local area. If you haven't seen it, it's hard to do it. If you've seen it, it's like, okay, well, they did it, maybe I can do it.
Just another question. You mentioned that you decided to go hardcore saving when you had a family, while you've got a family. How did they cope with that? When the ice cream van shows up and you're like, no, I don't think so.
Yeah. Well, necessity is the mother of invention. You can, one of the things that I kind of write about and think about a lot is that, people are capable of much more than they think they're capable of. And you kind of don't know what you're capable of until your back's against the wall. And so, it would be easy to, a lot of people just instinctively say, oh, well, I couldn't do that. I couldn't get a 50% savings rate. But it's amazing what you can do when you're absolutely fucking terrified. And when I was, I had a kind of career crisis, as I kind of alluded to it, when in my early 30s, and my wife had stopped work. So I was the sole breadwinner. We had one young child, another on the way. And I was doing a job that I absolutely hated. And also it was a terrible job market at that time. And I'm like, oh shit, I'm not going to be able to get another job. Therefore, I need to like emergency save for a period of months. And when I was doing that, I wasn't thinking so that I can get to financial independence. I described it as my redundancy fund. You know, what I thought I was doing was saving for an emergency kind of unemployment fund or retraining fund or whatever. And so to me, as I say, like, you know, when you do what it takes. So I thought like we just turned all the taps off in terms of spending. So we just stopped all restaurants, no going to the pub, no going to restaurants, no holiday that year. You know, we just turned everything off. And it was just amazing to me that, you know, when you saw what was possible, you know, in terms of like savings rate, it's kind of amazing what you can do if push comes to shove.
Great. Thank you. We have the questions coming thick and fast on the chat. And somebody says that it would be great to get a tattoo of it's amazing what you can do. That's incredible. So another question about your kids. Well, firstly, one from me. What do they think of your blog? Do they read it?
No, they refuse to read it on principle.
Okay. Do they know anything about fire? Do they have any concept of fire?
So, I mean, that there's a kind of broader lesson from that, which is with all of this stuff, you can't really sort of force people. You can't really force this down people's throat. And so, you know, my kids are sort of vaguely aware that, you know, they're vaguely aware of the blog, but they don't, you know, they won't be kind of pushed into reading it. And so you have to kind of, I've adopted more stealth tactics. So, for example, you know, I just strategically leave around copies of The Millionaire Next Door, for example, or well, I say copies, like single copy, or Your Money or Your Life. And I just know, I make sure that they are aware of those books, because I just remember from my own childhood, you know, my parents never actually said, you must read this book. And if they had, I probably wouldn't have. But I did just, you know, when I was bored, like browse, look at the bookcase and see what was there and kind of flick through some of them. And really, you know, what I'm trying to do with the kids is on the reading front is just kind of plant seeds that may or may not take. So that's the sort of on the reading front. But on the just more generally, you know, the most powerful thing you can do is just model the behaviors. So, you know, it doesn't matter what I say, or it doesn't matter what a book says. You know, if I'm buying a new car on finance, you know, they're going to see that, and that's going to be lodged away, filed in the back of their head. So, you know, the way that kids learn is through osmosis. They learn through observation, osmosis, and they're like sponges. They kind of suck that stuff up naturally.
Guy, did you want to ask a follow-up question about insights of teaching your leading by example, or teaching your kids? Or has that answered it?
His daughter's asleep, babe.
All right.
So you need...
Yeah, Guy is on his lazy fi dad He has his own blog as a parent, as a fire parent. And his question was about, are you leading by example or are you teaching? And we're both. And I think you've answered that already.
So one of the, I have done a bit of, I have walked my daughter and my sort of my son through like a compounding calculation, that kind of classic thing that I always bang on about on the blog, of the example of Kate, who saves £15,000 between 18 and 25, and how that turns into £1 million by the time she's 65. I've walked the kids through that, and they can do that on a spreadsheet.
Mm-hmm. More than most.
And so, yeah, I mean, it's just the thing that I hear from people just again and again and again is, oh, if only I knew this stuff at school. If only I knew the power of compounding. If only I knew those numbers when I was, 18. And so, my kids won't be able to say that. they'll have to find some other excuse.
Yes. Another follow-up question from Danny, which I'll ask, if that's okay. Did you know about FIRE before you were actually financially independent, or is it just you had this goal of being?
I never knew about it. So Your Money or Your Life came out in 1991. And so it existed, but I'd not read that book. And I didn't know, I'd not read any of the blogs or any of the books. I did find a book called Invest in Yourself in about 2000, which is an American book, which is a sort of kind of a FIRE book. But I hadn't found the classics, I always think the two classics are The Millionaire Next Door and Your Money or Your Life. I mean, there's a ton of others, but those, to me, if I could only recommend two, that it would be those books. So I hadn't discovered those. I was kind of stumbling around in the dark. I mean, I only found Mr. Money Mustache. I found the movement when I found Mr. Money Mustache in whatever it was, 2013.
So that was just about the time, or just before you got financially independent.
Yeah. So at that point, I'm reading it thinking, hold on, there's this 25 times rule, and there's this, and I'm like doing my maths, and I'm thinking I might be there actually. I mean, before I found Mr. Money Mustache, I had a spreadsheet, and the key metric on that spreadsheet was what I call my runway, which is just net worth divided by my burn rate. So, my annual spending divided into my net worth. And that gave me the number of years that I could work for, assuming no income at all and no capital gains at all. And so and it was over 25, it was just a little bit over 25. And then to kind of stumble across Mr. Money Mustache and find, there's actually a 4% safe withdrawal rate concept, and there's a 25 times rule. It kind of codified this stuff that I've been trying to wrestle with in my head.
Fantastic.
So I don't know if people can hear me. Am I coming through all right?
Yep.
Thanks. So there are a few questions in the chat, Barney, about that phase of your life. When did you decide to stop full-time work for other people and start doing your own thing?
Yes, so that was in 2013, and so I had a really full-on job, and I kind of I realized I had enough. I realized that I couldn't do that job forever, and I didn't want to do that job forever. And so in some ways I did it all wrong, because I essentially quit the job with no plan. So now I would kind of, if I was talking to someone and they were, approaching a position of financial independence, I would just say much better to kind of have a more of a smoother transition, a glide path transition, kind of start, maybe, drop down from 5 days a week to 4 or 3 days a week, kind of make the transition a bit more gradual. But I literally went from working, all the hours in the day to kind of nothing. And that was, as I say, that was 2013.
Okay. And now we spoke about this, and we know that you're conscious of not wishing to make tonight a platform for you to promote your own business. But I told you there would be questions about what you do today, about your coaching business. Could you share a little bit about that, please?
Yeah, I mean, it always kind of bugged me that the financial services industry didn't seem to deliver, for most people. So, obviously, if you're very, very wealthy, you can probably afford, a wealth manager, and the fees on that are kind of eye-watering. But it's essentially, the way the economics of the industry work is that it's uneconomic for most people to get traditional financial advice. And so essentially what the industry does is it just focuses on the high net worth people, and it gouges them on percentage fees, and everyone else is basically just ignored. And so I did look into becoming a conventional financial advisor, when I left my job. So I actually went and talked to St. James Place, who run this scheme where they kind of take people and turn them into financial advisors, and then they kind of go off and become sort of salesmen of St. James Place products. And I was so fucking horrified by the economics and the charges and the fees and the ethics, or lack thereof, of what they were doing, that I just thought, this whole kind of this whole industry model is broken. This whole idea of charging a percentage of fees and basically keeping the customer in the dark is just dishonest, and it's a broken business model. Now the problem is, and so I have some sympathy though for traditional financial advisors, because they are heavily regulated, and it's quite costly for them to be regulated. But I just thought, surely a better solution is not to kind of spoon feed people, not to tell them what fund they should buy, not to kind of arrange their investments for them, but just to educate them about the principles, so that they can make their own decisions. And so that's what I try and do. I describe it as teaching people to fish rather than selling them fish. And so, I mean, when I first started doing that, a lot of people say, well, I don't really understand, what's coaching? Why can't you just tell me what fund to buy? And so I've essentially, I think, educated people that there is this different product, and it's suitable for different people, and it requires people to be grown-ups, and to be intelligent grown-ups, and kind of make their own decisions. I can't tell people what to buy. I don't want to tell people, what to buy. I want them to make their own educated decisions. So that's kind of the philosophy behind it.
Great. James had a question about financial coaching. Did you want to ask your question, James? For advice for people who are thinking about becoming coaches?
Yeah, that's essentially my question, Caroline. I think you've already just given us some insights as to a little bit about what it is, but would you recommend it as a potential career path for somebody that's about to reach a financial independence, or anyone along the curve?
And I guess also, what are the qualities of a good coach? How do you know
Yeah.
be a good one.
Yeah,
Thank you.
to be honest, I generally say no to that. It's a kind of it's a tough way to make a living. You know, there's a reason that traditional financial advisors don't operate on that model, because, you know, and the reason is the economics are inferior. I mean, if you just want to make money, the St. James Place model is a far superior model. The problem with coaching is essentially you are making yourself redundant as quickly as possible. So as soon as my job is to make myself redundant, and so that's quite satisfying, but it's not a very good way to make money. So it's kind of okay for people that are financially independent, I think, because essentially your investments can subsidize the fact that you're not making much money from coaching. But what I would say is you need a hell of a grounding in financial services to be able to do it safely. It would be quite easy to kind of do it badly and to kind of get yourself in trouble with the regulator.
Yeah, that's the industry I work in now, so I'm glad you said that. Yeah,
so I think it makes perfect sense for someone that's been regulated as an IFA. I think for them, if they get to financial independence, they can flip over to the coaching model, no problem. So they're your limitation. So that essentially you're recognizing you're going to make less money. Fine. If you were previously a kind of qualified regulated financial advisor, you've got you have the capabilities to do it without, being dangerous. So that's great. The main thing you'll need to do is persuade and educate the customers that it's a thing.
Great.
It makes sense. Thanks, Barney.
Sorry, on coaching is who's that from? Stephen? From Guy. Are you happy with the decision? If you're not advising other people to start coaching, are you happy with the decision that you made to be a coach? Oh,
I mean, I love it. I love it. I just say it's just a terrible way to make money. So, it's yeah. So it's because essentially, if you're the sort of person that's got to financial independent, then you probably had a certain level of income and aptitude and application, etc. And so there are easier ways to make money. So as I say, go and work for St. James Place if you want to make money. But so it's terrible for the money, but it is rewarding. It's quite it can be quite draining actually, because you have to meet people where they are, and I might have to talk in the morning to someone who's sold a business and they're a multi-millionaire, and then in the afternoon I might have to talk to someone who's who's kind of broke and struggling. And so you have to be able to span a very wide range there.
Barney, how are you? Firstly, very good. I just wanted to mention a few things as well. So you mentioned the regulatory model in the UK. I do feel that there's need for change there. I'm an advocate of financial education. I was an advisor in the UK and now live in Vancouver, Canada. Okay. And I've spoken this group a few times, and as well as Manchester group as well. So yeah, you're right. The industry is in need of change because it does eliminate people with a lower net worth to seek advice because of the charges. And I think that was implemented in 2012 because of the need for transparency behind commissions. And I think what you're doing is great. Coaching is a huge part of helping people as well. So I admire you for that as well. St. James's Place, I agree with you as well. I've seen their model. I do not like it at all. People's knowledge is very, very different as well. And it's great that you've actually seen that as well. One bit is the younger generation of people coming through there are different in the way they approach things as well. And I think people are realizing the differences in type of things that they need now. And, I mentioned in the group, and I've said it many times before, I don't really think people need an advisor unless it's complex calculations or things that people need. There's so many people in the industry now in the FI space that talk about investing as well. So that's a huge thing as well. And, I admire what you're doing to keep up the good work as well. Some people have very, very, very skills as well. So it's about finding people that you can work with and utilizing that and just using that resource and carrying on your journey, whatever that may be, with people.
Yep, I completely agree. We're kind of violently agreeing with each other. Someone in the chat sort of said, not all financial advisors are like St. James Place, and I agree. I speak to people like Andy Hart and Pete Matthew from Meaningful Money, and kind of support the work that they're doing, which is a mixture of regulated financial advisory work, plus coaching, plus just kind of public education. And so there is scope for hybrid models.
All right, let's change gear a little bit. You spoke earlier about how it's amazing what you can achieve when you decide to cut your spending, right? And I think the last year has actually opened a lot of people's eyes to that.
Yeah.
What do you think the last year has done to the FIRE movement and people's disposition towards their personal finances in general?
Well, what I know it's done is it's taken the UK savings rate from like 3% to about 33% at the peak of the first lockdown. So from 3% to 33%. And, before COVID and before lockdown, people would kind of find my blog, or they'd find an article on whatever the Daily Mail that I'd appeared in, and you'd see this long fucking list of angry people saying, who's this guy saying it's possible to save 33% of your income or whatever. And well, it turns out that the entire country is capable, on average, of saving 33%, when they're locked down. And so, to me, lockdown showed what's possible. It just shows what's possible when you don't need discipline, or when you have discipline. It also showed the value and the kind of the need to have an emergency fund. To me, that was the biggest lesson of all. Like, just for goodness sake, get out of debt and have an emergency fund. I mean, personally, I would be fine if the whole financial independence movement kind of went away, if everyone would just get out of debt and have an emergency fund.
Right.
So I think that's just so important. But back to the point around lockdown, it showed us what was possible. It showed us what was possible for saving. It showed us what was possible in terms of working from home. Showed us what's possible for society, kind of cutting out all this excess commuting and excess business travel. So, it's back to my point. It just shows you what's possible when you really, 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 really want something, and when you really have to do it.
Okay.
And so I think of one way. I think of financial in the sort of FIRE movement and the FIRE approach. It's like the special forces approach to your personal finances. It's not about being reasonable. It's not about being normal. It's about, what can I do that's unreasonable and abnormal and kind of looks crazy to normal people?
Yeah. Cool. And then there's been a few good questions about, and we inevitably are going to get onto this, about investing. So what do you think it has done to the global markets? Because governments have printed a load of money. The markets did well last year, in spite of the fact that we see people have been laid off, people have been furloughed. You know, the hospitality industry really, really challenged. How do you think? How do you explain how strong the markets look, and where do you see things in 6 months to a year? If I may be so cheeky and ask you to forecast the future.
Well, let's start with what we actually know. Let's start with what actually happened. Let's kind of start with the facts. You know, what was striking was the sell-off in March of 2020, and really, again, the good news. The good news when I'm talking to someone and they're kind of worried about their reaction in a future crash. Well, I say, did you hold on to your investments? Did you hold your nerve during March 2020? Because if you could hold your nerve then, that was a pretty good kind of dress rehearsal for, you know, any number of kind of bad things that might happen in the future. So what was March 2020? It was a test. It was a test of investors' nerves. You know, it cleared out a lot of kind of speculative people. And then what happened? The government stepped in and you know, kind of flooded money into the system and have been printing money ever since. So really, I think the thing that worries me is bond allocations in this world. So if you think about a traditional kind of conventional asset allocation model from the past of whatever 60% equities, 40% bonds, that kind of terrifies me in a world where the government's expanding, just printing money so rapidly, and interest rates are like 0.5%. And so bonds look like they're, you know, not much return for quite a lot of risk going forward. So I think that, you know, I'm kind of a great believer in buy and hold forever in equities. I'm a great believer in be as brave as you can afford to be. The most important thing is to be able to sleep at night. And, you know, to my point around, you know, the FIRE mentality, I think you have to get comfortable with equity risk in today's world, because bonds are just not going to do it for you. You know, I always use the example of, you know, money in cash and money in bonds right now is like an ice sculpture at a wedding. It's evaporating.
Stephen, did you have a question, a follow-up question about investment and asset allocation?
So yeah, it was just around your thoughts on especially US Cape and in general, I guess, global Cape. And if it's not too personal question to ask, what is your active versus global passive allocation?
Sure. I mean, I used to worry about the US Cape, but I don't think, for a number of reasons, I think, what are the most dangerous words in investing? This time it's different, right? But I actually think in some ways it is different. And there are good reasons why the US Cape is as high as it is. And so I'm not kind of panicking about that. I'm quite happy to own a global tracker fund with the US at, you know, 60% of 60% of that. You know, if you look at just like where's all the innovation coming from? US tech. Where's all the growth coming from? US tech. Where are all the returns coming from? US tech. So I don't want to own a bunch of, like, you know, UK banks and oil miners because the Cape's lower. So I'm kind of, I don't obsess about the Cape. then you had a question about like kind of how I invest, and I'm I kind of look to be 80-20 equities to sort of cash / fixed income. It's kind of my normal target asset allocation, but if anything, I'm over that in equities at the moment because of the sort of stuff about bonds that I mentioned earlier. And I'm kind of roughly half between passive and half active. So the passive bit of my portfolio is like a Vanguard Global Tracker fund, and then I do some sort of stuff that I wouldn't recommend other people do, and the active bit.
Stop picking yourself.
Some stock picking, some active fund picking, some allocations to venture capital.
And then we are inevitably going to come to crypto. And I follow you on Twitter. I recommend that one. And the other day I read an article where you spoke about, I think, your university professor.
Oh yeah.
Could you share that story? I love that story.
Okay, so so the year is 1990. I'm 20 years old, and I'm in a sort of economics lecture, and the guy that's giving it is a sort of young, slightly nervous, slightly awkward, slightly geeky guy who's telling us that the banking system in the future will be disrupted by new currencies invented by the private sector that will compete with the pound and essentially kind of take over because the pounds will be inflated by governments. And we all just, there was like a titter went around the lecture room. We basically just laughing at this guy because it was like he was talking about science fiction. And so it's kind of hilarious to me that we thought this guy was an idiot. And then scroll forward to now, Bitcoin's at whatever, $50,000 a coin. And I've made no money from that, even though I was warned it was coming in 1990.
So that's really interesting, Barney, because you said you wouldn't advise people to do this. And I think in the FIRE community, we do get a bit into the mantra of index funds, Vanguard, don't do P2P, don't do, all these other things. How do you know when something is a fad? I mean, of course you can't know, but what are the things that you would bet on? Or
that's the funny thing. Like, essentially, a lot of people, and I kind of include myself in this, in the FIRE movement, we've trained ourselves to be grumpy cynics or grumpy skeptics and sort of, laugh at people who gamble, laugh at people who try the hottest new sort of thing in investing. We basically, a lot of us sort of stuck to this mantra of, Vanguard is our Lord and Master, and we will follow our Lord and Master at all times. And that definitely, if you kind of train yourself in that way, it does. The cost of that is you're going to be slower to adopt something like Bitcoin. So there is definitely an interesting dynamic there. I mean, to be honest, that's the kind of being skeptical of fads and speculative frenzies. It's a pretty good starting point. I mean, it's kept me out of a lot of trouble over the years. So it's not a bad, I think that you have to kind of look at something. You start from a position of skepticism, and the article that I wrote a couple of weeks ago was really talking about the fact that what's at the top of the rabbit hole is not the same at what's at the bottom of the rabbit hole. So if just at the top of the rabbit hole, you just see a bunch of obnoxious young guys, who've made like $10 million, on Bitcoin, laughing at everyone else. And you think, well, that's kind of obnoxious. And if you just stop there, you obviously wouldn't get involved. But when you go past that and you drill into it, what's interesting is some of the other stuff that's happening in crypto. And essentially what's happening is a new alternative finance system is being built from scratch that will disrupt the current financial system in ways that we can't yet fully understand. But my point is that, you know, real stuff in the real world is changing. There's a huge community of like software developers who are building a new financial world online, and so that's going to be really interesting.
Thank you. Amit, did you have a follow-up question on crypto?
No, that's perfect. That's answered it for me. Yeah, because just wanted to know what part of asset allocation portfolio would you actually recommend?
I think if you're thinking in terms of crypto, you know, people like Nassim Taleb, you know, what he said a few years ago was you basically should have, you know, 1 or 2% of your portfolio in Bitcoin, because it has, you know, certainly if you get in early, it's got much more upside than downside. So, you know, if you buy in whatever, if you buy in at $1,000 a coin, you know, you can lose 100%, but you might make, so you can lose 100% on the downside, but you might make 10,000% on the upside. And so if it's something like that, then, you know, why not have, you know, 1 or 2% of your portfolio in that? And because it's such, you know, with the sort of take up and the sort of amazing, I mean, Bitcoin's done 220% per year for the last decade. And so just having 1 or 2% of a portfolio in that, obviously that will have had a big effect. And so I'm not recommending like Bitcoin to anyone now. I mean, I do think though people should understand the space, and if you get comfortable with the risk, then yeah, maybe you should have 1 or 2% of your portfolio in something, and maybe that's Bitcoin, or maybe it's something else like Ethereum, or maybe you find like some sort of fund that gives you exposure to the space. I'm not pushing that, so I'm not really recommending that or disrecommending it. You know, it is what it is.
I guess you're always willing to take more risks for yourself than you are, you know, when you're advising other people. So
yeah, you know, it's always contextual, so it always depends on your circumstance. So if you've got let's say you had a rock solid safe government job, and you were out of debt, and you had no kids and no dependents, you know, and you've just got surplus money sat there being inflated away by the government, well, actually probably a pretty good idea to put some of that into crypto. And it, you know, if in a worst case scenario, it all goes to zero, okay, fine, you're still going to survive and you're still going to be okay. So I think that's the way to think of, that's the way I think about it anyway. Great.
Well, we will stop our crypto discussion there for now, because we are hoping to do a crypto meetup in the next month or two. Maybe we can turn Barney back for that. Gary, I'm going to hand over to you because I know you've had a couple of questions, so you can ask any of them now. Go for it.
Yeah, so I had 2 quick questions, Barney. First one being just a generic question. What do you think the biggest mistake you've made over, let's say, the last 10 years or so in your finances? Second question was about why you thought markets sort of rallied so hard back in March, April last year, when the world seems to be coming sort of to the end.
So biggest mistake was I panic sold in 2003. So I cashed out entirely of the stock market in March 2003 in my infinite wisdom, right at the bottom, within 2 weeks of the absolute bottom of a 3-year bear market. And so that experience kind of seared onto my brain that you should never, ever, 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 ever be a forced seller, never be a panic seller of equities in a crash. And, you know, again, it was that time that I kind of alluded to earlier when I was having a sort of career crisis at the same time, and I had a mortgage then, and so I realized kind of the evils of leverage, because I really couldn't. I just felt that I couldn't afford to see the investments go down any further when I basically was. I was losing my chance of being mortgage free because I had an amount of money in investments that would pay off the mortgage, and then it went down, 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 down. And I'm like, oh shit, I need to cash out and clear the mortgage. And so I did that. Felt great to clear the mortgage, but then immediately the stock market turned on its heel and then went up for the next like 8 years or something. And so I just, I learned my lesson from that. And so not the next 8 years, next 6 years. And so the next 6 years took us to 2009, the global financial crisis. And so in the global financial crisis, it genuinely looked like the banking system was going to collapse. It looked like Royal Bank of Scotland was going to, run out of money at the cash point machines. And when banking system goes down, it's like the power grid going down. It was going to be like a Mad Max scenario. But even though I was kind of absolutely terrified of that, I'm like, well, look, the market's crashing. I might as well fill my boots, because if we pull through this, it's going to take off like a rocket. And if it doesn't, what good's money anyway? So I basically backed up the truck in 2009 because I made such a dumb mistake in 2003. And so then when we come to 2020, it's burned in my brain. You must not sell. You must not sell. You must not sell. You must not sell. So there was no way that, no matter how bad, even if COVID had been Black Death, there was no way I was selling.
Barney, how long did it take you to get back in after 03?
Well, I started feeding in immediately, in the sense like with my monthly savings, but I was starting from zero. So it took me years and years to get back into the same, to build my investment pot up to where it had been. So it took me, I was essentially out of the market for several years. I'm dripping into it, but essentially out of it for several years. So I missed quite a lot of years of gains through that.
Do you think it is possible to learn not to do that just by hearing other people talk about it? Or do you think it's only really possible to learn not to sell by making that mistake? Because I've heard a number of people say they made that mistake and they never made it again, but they don't know if they would have been able to do that if someone had just told them.
Well, that's where the sort of cult aspects of FIRE are quite helpful, because if you're in this tribe and everyone in the tribe says you never panic sell, you never panic sell, you never panic sell, you never panic sell, if you hear that often enough, maybe it sinks in. So for some people, they need to burn their hand on the stove themselves. But for other people, if they're in a tribe of people saying never put your hand on the stove, then they don't need to put their hand on the stove. And so it would be nice if you were one of the people that didn't need to burn your hand on the stove to realize it's a bad idea to put your hand on a hot stove.
Oh, that would be great.
I mean, I funny enough, in March 2020, it was a pretty scary time, and for what it's worth, most of the people that I've spoken to since then kind of held their nerve, and so I say to those people, if you held your nerve then, you should be able to hold it through pretty much anything.
Great. I'm going to jump over to a quick question from Facebook, because I know not everyone's been able to get into the meetup room tonight, unfortunately. This is from Claudia, who's asking about advice for people who are late to the party. And she says she's 50, no pensions, only a little savings and next to no income thanks to COVID. How should she approach investing and risk? She's got at least 10 years, hopefully, probably more to go. But what would you advise someone who starts late?
Yeah, so you're playing catch up, and essentially it just means you've got to go extreme. It just means you don't have the luxury of, you know, being one of those people that says, well, I don't want to give up all those trips, those nice trips to Ibiza. I don't want to give up the trip, you know, the trips to the restaurants. You have to go extreme in that situation. And I actually, it kind of, it sounds crazy, but I'm kind of grateful for being put through that, what I call monk mode. I mean, I'm, you know, it serves you really well later in life because you kind of realize that it's not as bad as all of as that, and it just, it's very calming, it's very grounding. So, you know, if I was speaking to someone who's 50 and say I'm way behind and I need to catch up, I'd say great, go extreme, go hardcore, do whatever it has to. So ask for, you know, work overtime, take on extra shifts, get a second job, get a side hustle, go into monk mode, do all of the above, and, you know, and just throw yourself at it. Because in some ways, you know, in some ways that's really the essence of financial independence. It's just, you know, it's just normal good financial behavior, but like with the dial turned up to 11.
Mm-hmm. Yes, and I think Claudia's asking, should she go 100% equity for the first 2 years? And I guess you're saying, yes, go for it.
You've just got to, so you know, this is my point. You've got to go SAS. You can't be like, oh, I'd like to, you know, keep my cash safe and I'd like it in, you know, etc. It's like, no, you don't have the option now. You're going extreme. If you want to do this and you want to do it quickly, you've got to take some risks, and you've got to, you know, you've got to suck up some frugality, and you've got to, you know, you've got to hustle.
Great. Another one from Maria Santos. I'm not sure if she's in. Sorry, I cut somebody off. Just quickly, someone who's lucky enough to have a 60K pot of cash as an inheritance. What do they do? Single lump sum or pound cost averaging? They're
So
50 years old and planning to retire in 5 years.
So did you say 50 years old?
50.
So really that would depend on, you know, how comfortable they are with the market. So if they're an experienced investor, and let's say they're an experienced investor and that's not actually a huge amount in the context of their net worth, we'll just get on with it and do it at 9 o'clock tomorrow. Just bang it all in the market tomorrow. But if it's someone that hasn't invested before, then that would be insane. It would be insane to just bang it all in one go at 9 o'clock tomorrow, because emotionally they're not ready for that. And so if this is the first time they've had spare money and they've had money to invest, really what they should be doing is starting by opening a practice account and buying the Vanguard All World Equities ETF in a practice account, i.e. like not putting any money in. And then once they've kind of figured out the practice account, a week later, maybe putting £1,000 in. And then maybe a couple of weeks later, they put, you know, a few more thousand, and then they can scale in the rest of it. But it's being, you know, no one knows what the market's going to do. That's a distraction. The question is, are they emotionally ready for the volatility that comes with equities?
Right. Sorry, somebody else wanted to ask a question before. The floor is yours.
Yes, it was me, Caroline. I was just wondering what Barney's opinion was. I know he's been speaking about 100% equities, whether or not the opinion would be the same if we're talking about someone, for example, maybe in their 70s, for example, like mid 70s. Would it be the same advice for them? It's just I know so many people would be massively put off and maybe scared by being in such a risky portfolio, and the natural sort of answer is to go much heavier in bonds, but it sounds like you're not a great fan.
You know, you can't, they can't just go 100% equities if they're like 73 and they've never invested in equities before. That would be insane.
That was basically my question, exactly.
So they're just not equipped to handle it. They're just not emotionally equipped to handle it. And so again, you know, they should start from where they are, not from where they want to be, and you know, and get familiar and scale in and just get comfortable with it and make sure they know what it feels like to see it kind of wang up and down. I mean, essentially, I don't know the individual you're talking about, but kind of what springs to mind is someone that's essentially been brainwashed for most of their life. You know, just be a kind of sensible saver and don't put it in that nasty, evil stock market. And if that is the case, you know, to kind of turn around in your 70s and go 100% equities, that's probably going to end in tears.
I can put a little. I appreciate. I don't want to make it too long a conversation, but it's my mum, to be honest. She's been in the stock market for 30 years probably, but always in a lower allocation. Right now she's in her 70s and she's in a 60-40. Which sounds like maybe wouldn't be your cup of tea of fun, but the problem is there's quite a substantial amount of money. So I was just wondering, your opinion would change.
Again, the split doesn't really tell you much on its own. So if I said, like Warren Buffett, right, his standard advice, his advice to his wife when he dies is put 90% of it in a Vanguard equities fund and 10% in treasury bonds, right? So 90-10. And some people would say, oh, that's really risky to be 90-10. Well, not really, not if you got $10 billion, you know, because you got, that's $1 billion of treasury bonds. So the amount matters as well as the age and the risk profile, right? So you've got to take all of that into account for your mum.
Right, I know that time is marching on. Let's see who we've got time for. Linda, you had a great question.
Hi, sorry. My question was around your opinion around investing in property versus investing in pension. So I'm in my 30s right now, and I've been investing sort of almost 100% in pension. I am thinking about property, but I just feel like the rental income will just, the tax that I pay will just erode the rental income away.
So if you look at the returns on equities versus property in the UK, I think residential real estate's done about 8% a year, long-term average. Equities, maybe, you know, something similar, but maybe a bit more, maybe let's say 9% a year. The American stock market's done about 10% a year. So actually quite similar in terms of returns, with equities having had the edge. And so the way I kind of put it is, well, why would I take on all the hassle that comes with property and the risk that comes from having such a large amount of money in one single geographic location, one single investment, when I'm not really being rewarded for that risk? So to my mind, I own one house, but I own it to live in. I don't own it as an investment. And if you gave me an extra, you know, X £1,000, why would I buy a house with it when I'll probably get as good returns in equities, if not better, for no work? And, you know, you also, you know, the government kind of kindly gives us, you know, ISA allowances that shelter income and gains from equities that you can't use to buy a house, and, you know, pension, etc. So from a tax perspective, from a risk perspective, from a returns perspective, I personally prefer equities to property. Now, again, it depends on the individual. If you're like a super savvy, if you're a builder, property developer type that kind of is all over that market, then maybe you can make supernormal returns, you can make excess returns, but for most people, you'll make lower returns for more risk and more hassle.
And remember, as soon as you buy a second property, stamp duty nearly doubles. So if you're buying a small buy-to-let and then you want to move your main residence, your stamp duty could be astronomically high. So it's not just income tax, it's just, yeah, lots and lots of factors.
Yeah, I mean, the one argument in favor of property is leverage. So it's quite easy to borrow, you know, £500,000 from the bank to buy a house. It's quite difficult to borrow £500,000 to buy Vanguard All World Equities ETF. So leverage is an advantage, but leverage has got risks as well as, you know, it's risks as well as rewards. So I don't personally, I'm not, you know, I kind of like, you know, leverage can be helpful, clearly. And maybe that's what some people, you know, feel they have to do to kind of get on the path. Again, it's kind of, it depends on kind of who you are and what situation you're in.
Great. I will change tack with another question. Oh, sorry, Linda, did you have a follow-up?
No, that's it. Thank you.
A question that we often get asked about is, how do you spend your retirement? Assuming you've attained your magical number, you know, you could be on a beach drinking pina colada somewhere. You're obviously very driven to work. You've discovered a passion for writing, Barney. So can you tell us what retirement looks like? And is it what you expected?
Yeah, I mean, I don't use the R word. So I just,
police will get you.
I just don't frame it in that way. So you know, I think of it as financial independence rather than retirement. And it just allows you to do what you want to do. And for me, I just wanted a period, you know, when I first quit, I just wanted a decompression period. So I just wanted a period to kind of heal myself. And so, you know, I was quite happy essentially to have no structure and nothing to do, and just to basically not have a duvet day, but like a duvet 6 months. And then you just naturally, you kind of get your, you know, you're rested and recuperated, and your kind of energy comes back. And so you just, you know, I just found some experiments to run and some things to do. So I just experimented with, you know, I joined a local running club. I did more, you know, I did more exercise. I worked, you know, I did some sort of volunteering for some nature conservancy work, like you know, clearing invasive species and stuff like that. You know, chopping down conifers and sort of replanting broadleaf trees. So I just did and then I worked in a pub for a bit, and I worked behind the bar at festivals. I just did a series of experiments. And I was just in no hurry. I was in no rush, because you kind of know that you've got the money side covered. So you can take a bit of time to figure out what you want to do with your life. I mean, you know, it took me a while, and it took me quite a while to kind of get brave enough to put myself out there and say, I will do coaching for you. So it took me, you know, it took me I think it took me maybe a year, 2 years of writing the blog before I felt brave enough to do that. And yeah, that I kind of, I eventually said, well, you know, why would, you know, what am I worried about? If no one wants it, I can just take down the notice on the website, and no problem. But if there's a demand for it, then I'll find out. And so it's just a series of experiments. And I like being self-directed. So I like structuring my own time. You know, I don't want a boss to do that for me. I want to do that for myself.
Brilliant. Right.
Very good.
Question?
I do have a question. Sorry. So, Barney, we are unfortunately already approaching time, and I know there's so many more questions, and it's been a great evening. But I'm really curious. Are you living off your 4%, and what direction is your net worth going?
So, okay, I think that 4% thing is a complete distraction in many ways. So, the amount of intellectual energy that I see in blog posts and discussion forums, people, referencing different studies, and to me, it's kind of a lot of that is wasted energy, because the truth is this, that if you've spent like 20 years as a saver and an accumulator and an investor, you've come to train yourself to kind of carry on accumulating. And essentially what I've done with the coaching is get to the point where I've got a 0% withdrawal rate. And so when I think of that, I'm like, oh shit, maybe I should have just quit my job many, many years earlier and not been such a wimp, not been such a wuss. Because, I read this book called, it's an excellent book called What Should I Do With My Life by Poe Bronson. And it's 40 real life stories of people that made big, scary changes in their life, and they quit their corporate job, and there's lawyers that went off to be truck drivers, and there's an investment banker that went off to be a farmer, and all this sort of stuff. And I'm reading this and I'm thinking, all of these people did this without savings. And I kind of felt a little bit embarrassed that it'd taken me, that I'd felt the need to stash away this sort of life-changing amount of money to mean that I never had to work again. And so I kind of think that all of that sort of angst about the correct withdrawal rate is unnecessary if you can find something that you can do for the world that will carry on paying you a better money.
So do you think that having been a hardcore saver, that you struggle to break the saving habit, even though you've no reason to kind of save anymore?
It still feels good. I still want to, I still get excited when I've got some spare money that I can buy some more Vanguard All World Equities ETF. I mean, it's kind of sounds sad when I say it, but that's the truth. It feels good to make progress, and essentially what you've done is you've trained yourself like a dog over 20 years to take pleasure in forward progress. And so it would be very uncomfortable to kind of go into deaccumulation and have a mental model where I'm going to run my savings down to zero on the day that I die. That to me would feel incredibly uncomfortable, partly because I don't know what day I'm going to die, and I'd be kind of keen not to run out of money before that point. So I actually think that for a lot of people, once you've trained yourself to be a saver and investor, you'll want to carry on being a saver and investor.
I spoke to someone recently and I said, it's weird when you invest because you feel as though you've spent money, and you also feel as though your skin, you say, I'm sorry, I can't do that this weekend because I've just bought a load of Funsmith or something. And it gives you that feeling of having spent money. I don't know if anybody else feels this, but you feel as though you've spent money, that you've bought something, and that you're skinned because you've spent all your money. But you've spent all your money on an investment, if that makes sense. Yeah, I mean, look,
what I've realized is that, I mean, I just don't want, there's not that much that I actually want. And I tell you what I'd really like a six-pack, and I'm not going to get that by buying food, and I'm not going to get that by buying gym equipment, and I'm not going to get that by buying anything. And so, I think that in the early years, you kind of frame it as deprivation, but essentially what you're doing is you're training yourself to be happy with less. And at some point you actually believe your own you believe your own propaganda. It's like, I actually don't want that stuff anymore, you know, because at first it's like you're kind of saying, I don't want that stuff anymore, and a little bit of you did, but by the time you're my age, I actually don't want that stuff.
I think a key part of the FIRE journey is that you reassess what makes you happy and what you do actually want, rather than what the marketing outfits tell you want. And you establish what is your happiness.
Yeah, it's a reverse brainwashing process where you scrub away marketing, you scrub away advertising, you just remove, you reverse, your childhood brainwashing.
Can I ask a quick question, Barney?
Yeah.
Just to sort of bookend that a little bit, what do you think your money's going to be doing after you're not around?
Not my problem. It's just not my problem. I don't.
There's no particular plans then.
Well, I would like to, honestly, I would like to start giving a bit of it away. And I'm thinking at the moment, actually, I'm thinking of like starting to buy some land or something like that and like plant trees on it. But again, I'm hoping not to die too quickly, and so to me that seems like a long way off. And so it's just at that point, it'll be other people's problem.
Interesting. I think there was a question earlier about, do you plan to help your kids to buy a house or buy a car or something like that? Do you have this intention of passing things on?
I wouldn't help them to buy a car, no. I think that's potentially actively harmful. I might lend them a deposit. Or help them. I might do that. But I again, there's an excellent chapter in The Millionaire Next Door called economic outpatient care. And basically, if you want to ruin your children, buy them their first car, buy them their first, microwave, buy them their first holiday, yada yada yada, because you're just ruining them. You're just absolutely ruining them. Now, if you've trained them to be kind of super frugal and you can help them out with a house, well, there's a link there to, I'm funding a productive asset. So that maybe that's different.
Trying to choose the last questions here.
So Rob asked, did anyone catch the name of the book regarding life changes? Yeah. And that book is called What Should I Do With My Life by Poe Bronson.
I'll look that up. What was the best book you read last year, Barney?
Atomic Habits.
We have a lot of Atomic Habits fans here, I think.
I mean, that is an absolute, that's one of the best books about financial independence I've ever read, and it's not even about financial independence.
Yeah.
I mean, so that the mindset laid out in that book is, just in terms of, like the question about starting late, how do you rewire your brain, later in life to completely change your approach and kind of turn yourself into like this kind of super saver. Atomic Habits is awesome for that. And basically, you start small and you build on it, and you benefit from the aggregation of marginal gains. And so, those sort of people, when they ask that question about, I'm 50 and it is too late, etc., they haven't lived through the process of seeing the J curve. They haven't seen that that progression. They haven't seen the aggregation of marginal gains in practice. And so they kind of don't believe it's real. And Atomic Habits really lays out that framework very clearly. But in some ways, you basically have to live through that to believe it.
A request for you to list some of the books that you recommended. I'm sure you have a blog post
so
on that.
if you just know, there's a tab on my website at the top. It just says books, and there's 50 my top 50 books are there.
Brilliant. Speaking about the website, I have another question about your fantastic, now that's what I call financial independence music lists. How did that come up? And where do you find the songs?
So the inspiration for that was the song Dignity by Deacon Blue. And that just struck like such an emotional chord with me. It just like resonated. And I realized that kind of spoke to me on a deeper level than any personal finance book I'd ever read. And, you know, who gives a shit about, you know, those things that sort of say, you know, save a bit of money on takeaway, etc. It just, you know, it's all good stuff, but it doesn't necessarily speak to you and just go straight to your heart. And I realized that a song can do that in a way that like text cannot. And so, I mean, the secret of that series is that those are they're all songs I love, and I look for a way to, like a tenuous way to kind of tie it back. But they speak to me more on an emotional level than anything else. And, you know, I wrote a blog post called The Rider and the Elephant. And the concept there is that it is our emotional brain that is the elephant, and the elephant is making all the decisions. The rider is our sort of conscious, rational thought process. And the rider thinks he's in charge of the elephant. But if the elephant decides to gallop off, the elephant's going to gallop off. And the elephant is actually much more powerful than the rider. So your subconscious, your emotional brain are, you know, they are much more powerful than your kind of rational brain. And so back to the point we're talking about of like panicking in a market crash, that's where the elephant gallops off. That's where the elephant gallops off and does the wrong thing if you haven't trained your elephant. And so, yeah, the point of what I'm trying to do with the Now Financial Independence series is see if some of that stuff resonates with people.
Brilliant. Right, we're on 8 o'clock, and I know that you have your evening to get on with, Barney. So I'm going to call it quits there and say thank you so much for being here. And hopefully the next session that we can have will be in the pub, because those were where our first sessions were held. It's coming very soon. We will stay on the call for everyone else. We'll do open chat, and you guys can talk about
yeah, I mean, I just wanted to say thank you for doing those meetups, Caroline. It's awesome. It's absolutely awesome what you've done. So thank you very much for that.
Thank you very much. I don't think we do very much for the FIRE movement compared with you, but we won't have a competition. But thank you for being here. It's been fantastic. I'm sorry for everyone who asked questions that we didn't get to.
If anyone on this call wants to ask me a question, just email me. My email's on my website. Mm-hmm. So like barney@escapeartist.me. So anyone that has got a question that I haven't answered, they can just email me direct.
And
thank you very much, Barney.
The link of your Facebook group, because you have an Escape Artist Facebook group.
But email is the best way. So if you're on this call, send me an email and say that you're on this call, and say what your question is. Because if you don't say you're on this call, I'll probably ignore it. But if you're on this call, I'll make sure I answer it. I promise.
Brilliant. Thank you so much.
All right.
Bye, Barney. We'll talk to you soon.
All right. Thank you very much.
Thanks, Barney.
See you later. Bye.